German yields fall as investor focus shifts to this week's ECB interest rate decision. Welcome to Market Insight. I'm Ramzan Karmali. So this Thursday, the European Central Bank is widely expected to trim 25 basis points from its deposit rate, and according to all but 2 of 75 economists polled by Reuters, by at least 100 basis points more next year, as the economy slows and fears mount about US tariffs. But could recent political uncertainty cast any doubt over the future of the easing path? Well, to help answer that and more, I'm joined by Tim Graf, Head of Macro Strategy for EMEA at State Street. Tim, thanks so much for joining us. So this Thursday, are we right to say a 25 basis point cut by the ECB is nailed on, or is there even a chance of 50?
I think it's a pretty slim chance it is nailed on. I think that is very much the consensus forecast. The rate market has a little bit priced in above that just to account for that probability that they go with a larger 50 basis point cut. But I would say the risks that would drive that, you still really need to see them materialize in more meaningful form. And they're not going to necessarily act preemptively until that happens. So I think it's pretty baked in that it's 25.
But there has been an uptick in inflation readings over the last few months. Could that have some bearing, perhaps?
I don't think so. A lot of that is down to base effects in terms of the rise of annual inflation rates. In fact, we track inflation online using goods prices in the Eurozone, and we've continued to see very steady disinflation. In fact, if you look over the last 6 months or so, you look at an actual price index of goods prices scraped online, the price index has not moved in 6 months. And so that disinflationary process that began 2 years ago and that was slow to really get started really has continued into this year. And I think remains the case even if last year's readings were a little bit weaker, and that by mathematics just pushes up your annual rate through base effects.
Tim, what about the political situation in France? Do you think that could have any influence on this decision at all?
Not quite yet. Again, here is a risk that we all kind of know about, but where the worst outcomes have not really materialized. And it's a risk, I think, that at this point is pretty well understood. I mean, yes, French bond spreads to Germany have widened, but French yields are actually near the lows of the last 6 months. So it's not as though France really has a sort of a solvency crisis. They don't even really have a liquidity crisis at this point. And the nominal growth rate in France is still greater than the cost of their debt. So they're a long, long way from this being anything close to a debt crisis. It could get worse, but it's not nearly bad enough to warrant an aggressive policy response from the central bank, at least not yet.
Now, what's your outlook for interest rates next year? Currently, the ECB is at 3.25. How low could they go, possibly?
I suspect terminal rates will be about 175, and then they'll probably pause. If policy needs to ease, they will go further than that. I see that as kind of the neutral to maybe slightly easy level if you think neutral rates are around 175 to 2%, as I do. So that gets you to neutral. It maybe gets you a little bit into easy territory, as I say. At that point, they'll hopefully have seen inflation get back to target core inflation, that is. And some of the easing they've done already so far may start to see some green shoots of recovery in response to that, given the lag between previous easing and data that you start to get maybe mid next year. But I think as a starting point, you get to around 175. So 6 more cuts, including this week, would be my base case.
Now, do you think there could be some impact of a Trump presidency going forward on ECB policymakers? Could we see a quite divergent policy compared to the Fed, perhaps?
I would think so. The US data has just been that much stronger. In both cases, inflation expectations are really not out of control in either the US or the Eurozone. So at this point, I feel like it's kind of steady as she goes. But if there is one economy where you suspect inflation expectations have the chance to rise from here, it would be the US because of the mooted Trump policies. But we don't see that yet. It is a risk for next year. Generally, the US outlook, I think, is more upbeat when you consider where the US is growing relative to trend and where it's likely to grow relative to trend. So yes, there should be some divergence. It needn't be a huge divergence at this point, but we keep our eyes on those inflation expectations and what the Fed might do in response to that.
Tim Graf from State Street, many thanks for your thoughts. And that's Market Insights. Don't forget you can watch more videos on Reuters.com.